First question we're going to look at is going to be dealing with accounts receivable subsidiary ledger. Vail Company recorded the following transactions during November. And so we see there that they made several sales, and then on November 21st, they had some kind of a return or an allowance, and then they made another sale on the 30th. And so what we're going to do is we are going to prepare a general ledger having T accounts for the accounts receivable, sales, sales returns, and allowances. Also open an accounts receivable subsidiary ledger having T account for each customer. Post these entries to both the general ledger and the accounts receivable ledger. So first of all, what we'll do is we'll go ahead and post our accounts receivable. So November the 5th, again, it would be a debit. So you remember debit and then credit. So remember, this is the debit side, and that's the credit side. So we'll go ahead and post our accounts receivable for the ski shop, $4,615. Sales, again, that'd be a credit, $4,615. And then we'll put so we'll go ahead and open up in the subsidiary ledger an account for ski shop. And so that would be a debit of $4,615, which corresponds back to the accounts receivable. And then November the 10th, we had a sale from to Welcome Enterprises, $1,350. So again, same thing. But we'll go ahead and open up another account for Welcome Enterprises. And then we had a sale for Zia Nataria of $832. Same thing, we'll go ahead and open up an account for them. So we put it on the debit side. And then we had some kind of a return or allowance. So they either could have returned merchandise to us, or we could have given them a discount on it after the fact of $209. So you have a debit for sales, returns, and allowances for November 21st for $209, and then that would then be a credit then to their account in the subsidiary ledger for $209, as well as a credit to the accounts receivable, because it's going to reduce the amount that the company owed, as well as reducing the amount that we expect that we're going to collect. And then we have one, again, a sale for the ski shop, $2,713. So again, debit to accounts receivable, debit to ski shop, and then credit to the sales. And then we can go ahead and total each one of these up. Okay, because again, you add up all of these, subtract this. That's how you're going to get. So you're going to add up all your debits, subtract the credit. That'll get your balance. Again, these you just add them up and carry them down. And then for Zia Natural, you take the owing balance original of the sale, $832, subtract $209, you're going to get your debit balance for what they owe. And then we'll go ahead and prepare our schedule for accounts receivable. So again, if we look at each customer's account in the subsidiary ledger, we can just list them out. So Ski Shop, they owe $7,328. Welcome Enterprises, $1,350. Zia Natura for $623. We can add them up, equals $9,301. We see here that matches the balance in our accounts receivable, $9,301. So now we're going to talk about how do we account for credit card sales. Levine Company uses the perpetual inventory system. So we're going to prepare the journal entries to record the following credit card transactions for Levine Company. And so the first one is they sold merchandise on April the 8th for $8,400, and the merchandise had a cost of $6,000, and accepted the customer's SunTrust bank card. And SunTrust Bank charges a 4% processing fee. And then we sold merchandise again on April the 12th for $5,600, had a cost of $3,500, accepted customer's Continental card. Continental charges a 2.5% fee. And so first of all, we'll talk about April the 8th. So again, we have a credit to sales in the amount of $8,400. And then we have a debit to credit card expense. Again, we're going to figure that how much that is by taking the amount of the sale, $8,400, multiply by 4%. And so 4% as a decimal is 0.04. And so that would be a debit of $336. What is the processing fee? And then we receive cash, then, so it'd be 96% of it is actually what we're receiving, would be $8,064. Or you could just take the cost of the sale minus the processing fee. That would equal the cash. Remember that your debits always have to equal your credits. And then we can also have to record the cost of goods sold. So we have cost of goods sold, debit for $6,000, because it says in the problem that it had a cost of $6,000. And then we have to credit merchandise inventory for $6,000, because now we've sold it, it's now no longer in our inventory. And then same thing, to record our sale on April the 12th of $5,600 is a credit to sales for $5,600, a debit for credit card expense. Same thing, so $5,600, this time it would be times 0.025, which is 2.5% converted to a decimal. So the processing fee would be $140. And then cash would be $5,460. And again, you could take $4,600, subtract $140, you're going to get the amount. And then the cost of goods sold, same thing, is a debit for $3,500, and then credit to merchandise inventory $3,500. This time, rather than using a bank card, this like a normal credit card, like a Visa or an American Express, that's what we were talking about. Now we're going to talk about how do you do it if it's a charge account that is actually held by the store. Zmart uses the perpetual inventory system, and they have their own credit card, or it could be like their own in-house charge account. So like before, I remember I was telling you about the local hardware store where they have kind of a tab account where you just go in there. If you're a business, they give you credit, you go in there and do it. So kind of the same thing, okay? But this is something held by the store rather than a bank. So Zmart charges a per month interest fee for any unpaid balance on its store credit card at each month end. So we'll prepare our journal entries to record the following transactions. So on April the 30th, Zmart sold merchandise for a total of $1,000. It cost Zmart $650 and accepted the customer's Zmart store card. And then on May the 31st, the Zmart recorded $4 of interest earned from its store credit card as of this end of month. And so in order to record the sale, is you would debit accounts receivable $1,000, credit sales $1,000. And then we have to also figure out and record the cost of goods sold. So we have a debit to cost of goods sold, $650, credit to merchandise inventory, $650. And then in order to record the interest on May 31st, we would record a debit to accounts receivable, the amount of $4, and then we would credit interest revenue for $4. So it's similar to what we did up here. Sales is a type of revenue, okay? So we credit that $1,000, but in this case here to record the interest, we have a separate interest revenue, and so we credit that $4. And then the same thing here would be a debit to accounts receivable. It's the direct write-off method. So this is when somebody they have a bill and a company extends credit, and the customer has a bill, but the customer then refuses to pay or is unable to pay, then the business has to write off the debt. And so we'll talk about how we would go about doing that. So Dexter Company uses a direct write-off method. And so we're going to prepare journal entries to record the following transactions. So on March the 11th, Dexter determines that it cannot collect $45,000 for its account receivable from its customer Lear Company. And in March the 29th, Lear unexpectedly pays its account in full to Dexter, and Dexter has to recover the recovery of this bad debt. So there's a couple things here. First of all, we'll record how do we write it off. Again, this is called the direct write-off method. And so then we have in the accounts receivable ledger, subsidiary ledger, we have an accounts receivable Lear Company, and so they have a debit balance of $45,000. Okay, so in order to write that off, we would debit bad debts expense in the amount of $45,000, and then we would credit the accounts receivable Lear Company $45,000. And so we see here what happens then is, because we have a debit and then we have a credit, they basically then now that wipes this out. So as I say, now it brings the balance to zero. Now, on March the 29th then, so we wrote this off on March the 11th. Well, on March the 29th, Lear Company unexpectedly pays its account in full to Dexter Company. And so Dexter records its recovery for the bad debt. So there's two things here that we have to do. First, obviously, we have to record the cash, and we'll do that second, the cash that we receive and then paying off the account. The first thing we have to do is to reverse what we just did, writing it off, and reestablish the Lear Company account. Okay, so on March the 29th, we would have an accounts receivable Lear Company, $45,000 debit, and then we would credit the bad debt expense, $45,000. So that reverses what we did and does the opposite of what we did on March the 11th. Okay, so that reinstates their account. So that brings the owing balance of Lear back to $45,000. And then we'll go ahead then and record the payment. So we would debit cash, the amount of $45,000, because we're receiving money in. And then we would credit the accounts receivable Lear Company for $45,000 again. So same thing. So then it would bring the Lear balance then to zero, because now they've paid their bill. Percent of sales method, write-off method. At the year end, which would be December 31st, Chan Company estimates its bad debt as 1% of the annual credit sales of $487,500. Chan records its bad debt expense for that estimate. So on the following February 1st, Chan decides that the $580 account of P. Parker is uncollectible and writes it off as bad debt. On June the 5th, Parker unexpectedly pays the amount previously written off. So we'll prepare journal entries for Chan to record those transactions on December 31st, February the 1st, and June the 5th. And so the first thing would be figuring out the estimate for the bad debt expense. So we have bad debt expense, and then we have an allowance for doubtful accounts, because we're setting up the allowance for doubtful accounts. So you have bad debt expense, which is $487,005 multiplied by 1%. So that'd be 4,875, and allowance for doubtful accounts for that. And then on February the 1st, we are then going to write off the $580 account from P Park. So we would debit the allowance for doubtful accounts, $580, and then we would credit the subsidiary account for accounts receivable and then P Park for $580. And then when P Park pays, we would debit the accounts receivable P Park for $580, and we would credit the allowance for doubtful accounts $580. Basically, what we do on this transaction is we're basically doing the opposite of what we did when we went ahead and wrote it off, because now we're reestablishing their account. And then we will record the payment, cash debit $580, and then credit to accounts receivable P Park for $580. And then percentage of accounts receivable method. Maisie company supply company uses the percent of accounts receivable method. And so on December 31st, it has an outstanding accounts receivable of $55,000. And it estimates that 2% of it would be uncollectible. And so we'll prepare the year-end adjusting entry to record bad debt expense, assuming that the doubtful allowance for doubtful accounts has a $415 credit balance before the adjustment. And so we have bad debt expense, allowance for doubtful accounts. And so we want to figure out what 2% of 55,000 is, and that's $1,100. And then they already had in there 415, and so we're going to add to it 685, and so that would be a credit. So bad debt expense will debit $685, and then we'll credit the allowance for doubtful accounts, $685. That established the amount for the allowance for doubtful accounts. So then on December 31st, then what we have to do then is we had an outstanding accounts receivable balance of 55, estimates that it's uncollectible, but it had a debit balance. So it's the same thing. They're showing you if it had a debit balance, so then you would add. So you would add 291 to 1,100, and so you would get that you have to have a required adjustment credit of 1,391 in order to make this equal 1,100. So if it already had a debit balance, that's what you'd have to do. You'd add, otherwise you'd subtract if it had a credit balance. On the balance sheet, you would list the accounts receivable under the assets of 55,100. Then you would list the allowance for doubtful accounts, 1,100. Again, parentheses, that means that it would be a negative number or less that number. And so then the net of the accounts receivable then is 53,900, because that's the amount that we think we could collect. And this is the aging method. Those are all different methods that you could use, and you'd have to figure out. And the thing is, you'd have to stay consistent with it. So if you start using one method, that's what you'll use for that fiscal period. But these are all different methods that you can do to figure out how much you have to write off from the accounts receivable that's unpaid. So Daly Company prepared the following aging of receivables analysis at December 31. And so again, they had total accounts receivable of 570,000. And so of that is 0 days past due, 1 to 30 days past due, etc. And then you see the percent that they figure would be uncollectible. So estimate the balance of the allowance for doubtful accounts using the aging of accounts method. So remember that the aging of receivables method is that each receivable is classified by how long it is past its due date. Then estimates of uncollectible amounts are made, assuming that the longer an account is past due, the more likely it is to be uncollectible. We just list them out and we figure out then how much would be uncollectible from each time period. So for the period that's not due, so we take $396,000 multiplied by 1%. We figure that about 3,960 of that is uncollectible. So from 1 to 30 days is 90,000 multiplied by 2% is $1,800. 31 to 60 days, which is 3,600 times 5 is 1,800. And then 61 to 90, 18,000 times 7 is 1,260. And then over 90 is 30,000 multiplied by 10% is 3,000. So then the estimated balance of the uncollectibles, if we add them up, we're going to come out with 11,820. So we figure that of the $570,000 that's owed to us, that's owed to Daily Company, that's us. People owe that money to us. They need to pay it. Okay. We figure that of that, we won't see $11,820. That amount will be uncollectible. And so that would be a credit. So then what you would do then is we'll prepare the adjusting entry. And so we determined the current account balance equals, which is the allowance for doubtful accounts, is already has in there 3,600 from previous. And we'll determine the current, what it should equal, which is 11,820, which is what we now know we won't collect under the allowance for doubtful accounts. So then we'll record the adjusting entry for how we correct that. And so we know then that we have to credit it for 8,220. So again, if you take 11,820 minus 3,600, that's how you're going to get that amount, because it's all on the same side. So, because that's going to be your total. So you have a debit for bad debt expense, 8,220, credit for allowance for doubtful accounts, 8,220. And so you'll add that then as a debit then to the bad debt expense. So what it is, we haven't done anything with the bad debt expense yet, and so it's zero, because remember, it resets every year. Expense resets every accounting period. But the allowance for doubtful accounts, that would carry forward. Then on the balance sheet, you'd have it listed accounts receivable amount $570,000 under assets, less the allowance for doubtful accounts of 11,820, and so accounts receivable net would be 558,180. Then on the income statement, you have bad debt expense of 8,220, because that's what it is for the current period. Then we'll prepare the adjusting entry to record bad debt expense using an estimate from Part A. Assume the unadjusted balance in the allowance for doubtful accounts has a $3,600 credit. And so again, we had a $100 debit for the allowance for doubtful accounts, and so then we have determined the current account balance should equal 11,820. And so to figure out the adjustment, we take and add 100 to what it should be. We know the adjustment will have to be 11,920. So this is if the allowance for doubtful accounts had a debit balance, what we would do. So you would take and then debit the bad debt expense, 11,920, credit the allowance for doubtful accounts, 11,920. And now we use the percentage of accounts receivable method. Daly Company prepares the following aging of receivables analysis on December 31st, okay? And then we're going to, first of all, we're going to estimate the balance of the allowance of doubtful accounts, assuming that the company uses 4.5% of total accounts receivable to estimate uncollectibles instead of the aging of accounts method. So they're going to just use the total and just figure it's 4.5%. What you'll do is you'll just take the amount of the receivables, which is $570,000, multiply by 4.5%. It's going to be $25,650. So in this example, we figured that we're not going to collect of 570,000 of that. We're not going to be able to collect 25,650 of it. And so what we'll do then is we figure that it should But what it has now for the allowance of doubtful accounts is a $12,000 credit, and then the amount that it should be is $25,650. And so again, if you take the credit balance, 12,000, subtract that from what it should be, we're going to get that we're going to have to make an adjustment for 13,650 credit. So we would debit bad debt expense 13,650, credit the allowance for doubtful accounts 13,650. And again, that's how you would list it on the income statement for the amount of accounts receivable, and this is how you'd list the expense. And that's just kind of going through it. But if it was the unadjusted was a debit. About notes receivable transactions now. So we're going to prepare the journal entries for the following transactions of Danica Company. So on December the 13th, we accepted a $9,500 60-day 8% note dated December the 13th from Miranda Lee in granting a time extension for her past due accounts receivable. And then on December 31st, we will adjust the year-end accounts for the accrued interest earned on the Lee note. And so then what we're going to do is figure out at maturity how much interest total we would expect to earn. So again, the principal is $9,500 and then multiply by the rate, which is 8%, multiply by the time, which is 60, divided by 360. We use 360 as the base for how many days there are in a year. And the note is a 60-day note. So the total interest that we would collect is $127. And so then to figure it out for the 18 days, we'll take 9,500 multiplied by 8%, multiplied by 18 divided by 360 is, so of that, $38 would be during that 18-day period. So that would be earned from the 13th through December 31st. Now, the other portion would be the 42 days is what would be earned after that, which we're not concerned with quite at this moment. 9,500 multiplied by 8 multiplied by 42 divided by 360 is going to be $89 that we'll earn in the new year. So December 13, notes receivable, M. Lee, debit for $9,500 in order to record that. Remember that notes receivable is an asset because it's something that we expect to receive. And then the accounts receivable, M. Lee, we will credit $9,500. The reason for that is we're going to remove it from the accounts receivable because we converted it into a note. And then on December 31st, which during that period, there's 18 days that have passed. So we have interest receivable, which again is an asset in the amount of $9,500 multiplied by 8% multiplied by 18 divided by 360 is $38 of interest. So interest receivable, $38 debit, and then credit to interest revenue, $38. And then we'll go ahead and look at this scenario a little bit further. We're going to go ahead and prepare our journal entries. So the current year we've already done, so I'm just going to go ahead and put these up here because we talked about those earlier. We have some more transactions that we need to record. First one is on January the 27th. We received Lee's payment for principal and interest for the note that was dated on December the 13th. We have cash debit in the amount of $9,596.95, and what that comprises is a credit to the notes receivable, which is $9,500 because that's how much the principal of the note was. Then we also have to credit the interest receivable, $3,800. That wipes that out because we've now received it. And then we will credit the interest revenue, 57, which 57 is the amount of interest that accrued from January the 1st through January the 27th. Then the first one here is on March the 3rd. We accepted a $5,000 10% 90-day note dated March the 3rd and granting a time extension on a past due account receivable from Tomas Company. So we have a notes receivable, Tomas Company, debit in the amount of $5,000, credit for the accounts receivable of $5,000. Again, that converts the accounts receivable into a notes receivable. And then on March 17th, we're going to accept a 2030-day 9% note dated March the 17th and granting Hiroshi Chang a time extension on his past due account. So same thing, notes receivable H. Chang, 2000, and then a credit to accounts receivable H. Chang, 2000. And then on April the 16th, Chang dishonors his note when presented for payment. So Chang either he's unable or unwilling to pay his note. And so we have to go ahead and convert that back into an accounts receivable. So we have accounts receivable H. Chang, debit for the amount of $2,015. And so you have a credit then to the notes receivable of $2,000 because you're going to now take that out of the notes receivable, add it back to the accounts receivable. But you also have the revenue because he still owes us the interest revenue as well for that 30-day period. So $2,000 multiplied by 9% is going to be $15. So he owes us that as well. And on May the 1st, we write off the Chang account against the allowance for doubtful accounts because we realize that he's not going to pay us. So we have the allowance for doubtful accounts, $2,015, debit, and then credit for H. Chang receivable, $2,015. And then on June the 1st, we received the Tomas payment for principal and interest for the note dated on March the 3rd. So we received cash in the amount of $5,125. So then we have to credit the notes receivable Tomas Company, $5,000, and then the interest revenue, $125. So honoring a note. And the following are selected transactions for Vitrola Company. So on November the 1st, we accepted a $6,000 180-day 8% note dated November the 1st from Kelly White and granting to time extension on past due accounts receivable. And then we're going to figure out the interest on that. So $6,000 by the rate, which is 8%, 180 divided by 360. So the total interest is going to be $240. And so then we got to figure out for December the 31st would be a period of 60 days. So then during that 60-day period, 80 of it, so 80 of this amount is going to be accrued during December or through December, and then the interest recognized then on April the 30th. So 120 days of it remain, so that's $160. And so we'll use this to prepare our journal entries. So November the 1st, we have an accounts receivable, K White. We will debit, notes receivable. We will debit that $6,000, credit the accounts receivable $6,000. And then on December the 1st, we will adjust the year-end accounts with the accrued interest that was earned on the White note. So we have interest receivable of 80, interest revenue of 80. And then on April the 30th, White honors her note when presented for payment. In February had 28 days for the current year. And so we would debit cash in the amount of $6,240. We would credit the notes receivable, K White, for $6,000, credit the interest revenue, 80, and again, interest receivable for 80. And again, that is from the period, from the previous period. And then we will credit the interest receivable, 160, because that is the amount of interest from the current period. Dishonoring a note. Prepare journal entries for the following transactions of Ridge Company. And so on March the 21st, we accepted a $9,500 180-day 8% note from Tamara Jackson in granting a time extension for her past due accounts receivable. So we have a notes receivable, T. Jackson, debit 9,500, credit the accounts receivable 9,500. So that converts, that creates the asset, which is the notes receivable, and then that clears out her accounts receivable. And then on September the 17th, Jackson dishonors her note, so we would have a debit of accounts receivable 9,880, and then we'll credit the notes receivable T. Jackson for 9,500, and then the interest receivable credit for 360 or 380. So that's because we go ahead, we get rid of the note, we put it back on her accounts receivable. Then on December the 31st, after several tries to collect, Ridge Company has to write off Jackson's account against the allowance for doubtful accounts. So you have the allowance for doubtful accounts debit, 9,880, credit to the accounts receivable T. Jackson, 9,880. Selling and pledging accounts receivable. On November the 30th, Pet Roof Company has 126,700 of accounts receivable, uses the perpetual inventory method. So we're going to prepare the following entries. And so on so December the 4th, we sold $7,245 of merchandise that cost us $5,000 to a customer on credit terms net 30, meaning that our customer had 30 days to pay. So we would debit accounts receivable $7,245, credit sales $2,045, and then we would have to record the cost of goods sold, which is $5,000, debit, and then credit the merchandise inventory for $5,000. Then on December the 9th, we sold $20,000 of our accounts receivable to Main Bank, and Main is charging a 4% factoring fee. So we need some money, and so rather than to keep trying to collect this ourselves, we sell part of our accounts receivables to Main Bank. And of that, they're going to give us $20,000 minus 4%. So we're going to receive cash in the amount of $19,200. That's the debit. Again, that is $20,000 minus the $800, which is our factoring fee. And so we will also we will debit factoring fee expense. So 20,000 multiplied by 4% is 800, and then we would credit the accounts receivable for 20,000 because we're accepting 19,200 in lieu of the 20,000. On December the 17th, we received $5,859 cash from a customer in payment of their accounts. And so we debit cash $5,859, credit accounts receivable $5,859. And on December the 27th, we borrowed $10,000 of cash from Main Bank, pledging $12,500 of accounts receivable as security for the loan. So we would debit cash $10,000, and then we would credit the notes payable, which is a liability for $10,000. And then again, a note to financial statements. Accounts receivable in the amount of $12,500 is pledged as security for a $10,000 note payable to Main Bank. So you wouldn't have to do a journal entry for the if you're pledging the amount, but you do have to make a note on your financial statements that that's what you're doing. We'll discuss the accounts receivable turnover. So the following information is from the annual financial statements of Rahim Company. And so the first thing we'll do is we will calculate its accounts receivable turnover for year 2 and 3 and assume its competitors has a turnover of 11. Is Rahim performing better or worse at collecting than its competitors? We take the net sales divided by the average accounts receivable net. So in year 2, we have the net sales of 335,280, and then to figure out the average, you're going to add up 41,400 in year 2 plus the amount in the previous year, which in this case is year 1 of 24,800. So add those, divide them by 2. So you're going to get, so to be 335,280 divided by 38,100. That's 8.8 times. And then in year 3, you're going to take the amount of net sales in year 3 of 405,140, and then you will add up the amount of accounts receivable net year end in year 3 and year 2, divided by 2. So that's 405,100 divided by 43,100. That is 9.4 times. And so that means that they are turning over their accounts receivable 9.4 times throughout the year. And so that would be very good for them.